With the federal election now decided, the property investment landscape has changed, and this impacts every property owner. The good news is that there are now some great new opportunities in the market, but if you're wanting to maximise your returns, your game plan will need to change. Host of the Smart Property Investment Show, Phil Tarrant, and best-selling property author Paul Glossop, along with special guest Tim Lawless from CoreLogic, can help you make that change. Our live webcast will unpack everything you need to know to benefit from the property market in light of the policy changes and give you an opportunity to have your questions answered. Register your seat for this live webcast now at smartpropertyinvestment.com.au.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Phil Tarrant is not in the building today. You've got Alex Whitlock once again. Very pleased to be with you. Thanks very much for having me. Got a bit different show today. Very privileged to have Philip Ryan joining me. He's the Managing Director of Trilogy Funds. I met Philip some time ago when I was up in Brisbane, just working on one of our other titles, Nest Egg, which is sort of a broader investment show. And Philip's story really resonated with me, and I've been waiting for a long time to get Philip back down here specifically to talk to us about property and about property investment. Philip is a professional investor. His business is funds management with property and mortgage trust, but he is also a very, very experienced investor, and over many years has really had significant experience in investing, in building wealth, in understanding the psychology of building up assets in property and also in other fields. Philip, welcome on the show.
Thanks very much, Alex. Great to be here.
Great to have you down. So let's just jump straight in, Philip. I know from when we caught up last time, you began investing at a very young age.
I was about 14, Alex.
14 years old.
Yes, I was working part-time at a local garage, pumping petrol, and I saved up some money at school. And one of the teachers had just finished maths for the year. This was in grade 10, and he suggested that we play a share game, which we did. We did that. I think I won or became second in that game. And after that, I thought, well, look, I'll go out and buy some shares. So I contacted a broker in Brisbane and bought my first lot of shares. And in many ways, based on luck in hindsight, but it was after Cyclone Tracy and the Brisbane floods.
Okay.
And it was an insurance company which I thought showed a great prospect of doing well because it had a high dividend yield. But in actual fact, it had previously paid a good dividend the years before. But after the flood and after Cyclone Tracy, it had actually suffered badly. But to my luck, fortunes turned around, and from there it went well, and I sold it some years later for a good profit.
So I cast my mind back to being 14 years old, and my focal point for any money that I earned through a paper round or doing whatever certainly wasn't going to go on investing on something that may or may not make me money in the future. What were your friends doing at that sort of particular time, and what made you decide to use the dollars that you'd earned so effectively? What was the mindset to go and actually put those away for the future?
Well, my friends were doing anything other than buying shares, that's for sure. But I think it just came culturally within our family. It was I was told that, I think from my parents, that on many occasions we couldn't afford to buy things, or we couldn't afford to live in a bigger house, etc. And I sort of thought, why shouldn't we be able to? I got to say, at the time, I was probably very Labor bent. So If you cast your mind back, it was the Gough Whitlam era, it was Bjelke-Petersen government in Queensland as well, as anti-street marching. So on the one hand, I was a little bit torn from the social aspect, but also I think at the other end of the spectrum, what governed me was the fear of missing out. It was, look, I think I could do something better for myself, and I didn't want to be that person who thought, well, look, I'd love to make money, but for some circumstances couldn't. So I really researched it, and I actually spent quite a bit of time in the library when I started my law degree. I also spent time in the QUT library and also the Queensland Government Library, because that was the only area where you could actually get research on shares.
Okay.
And so there was nothing like Google or any other current availability of information.
Google wasn't even a wisp in somebody's mind back then.
No, so everything I looked at was actually very historical. And from there, at school, I bought exchange-traded options and ultimately went into buying some futures. That was gold futures and also silver futures. And at the time, there were only hard commodities, so there was no share price index futures. There were things like frozen orange juice and pork bellies, for those who can remember.
So I'd imagine that you were studying at this time for your law degree.
Yes.
Yep. So what was your mindset as a young investor? What did you think you were going to do with the assets that you were building or with the capital that you were building? Did you have a sort of a view as to what you wanted to do with that, even a sort of a short-term or a medium-term goal?
Look, I look back and I think perhaps I was a little bit odd because I'd create a yearly balance sheet and look at how I went every year. And really I was focused on building a portfolio as if it was a business. So that's really where I came from. It was a way of improving my income in terms of buying assets which could provide dividends on a regular basis and also capital growth.
So what was your family background, Philip? Were your parents investors, savers? What was their sort of attitude to money in those formative years?
They were quite conservative. It was a pretty typical nuclear family, and that was that Dad worked. And when he finished work in a business sense, he'd be home and he'd be working on the house. And and in those days, you did everything yourself. So rather than getting, I remember in the 1974 flood, rather than getting a bobcat in to dig trenches for stormwater, Dad did it all by hand.
Wow.
And also in the flood, he decided to build a stone barbecue made out of rock. We had tarpaulins over the barbecue while he was building it. So a lot of the time was his time spent working. And in my mum's case, it was providing for us generally too. So it was a pretty typical sort of middle-class background.
So you started to accumulate some wealth. You were saving money as you worked and sort of investing it as you went and building up a nice asset. So at what point did property become something that was a focal point for you?
It came a little bit later. In fact, it didn't really manifest itself probably to my mid-20s. For a start, I couldn't really afford to buy property when I was still a uni student or a school student. I actually had learnt some lessons from actually losing money. One of the companies I bought was a finance company, or shares in a finance company, which was backed by Reg Ansett at the time, who had Ansett Airlines. Well, that company collapsed when I was doing law, and I remember being quite distraught about that because that was my first loss, and at the time was
as a percentage of what you'd accumulated, how much of your investment sat in that particular asset class?
Oh, that's such a long time ago, but I suspect it was probably about 20%.
Okay, so that's a pretty heavy, and that company went bust.
Yes, so I got nothing out of that, and really my move into property was firstly driven by diversification because after being in shares, I thought I'd learn more about property. But the other thing is that there were a few things in shares which just weren't satisfying to me. For a start, there was no concept of control. When you buy shares in a company, you're really buying shares in a business, which you might have some general knowledge about, but it's not anything that you'd have a great knowledge about. And the other thing is that it's driven by a board of directors who you don't know. You've got no control over. So the issue I had with that is that I saw that in shares you've got interests in assets which you have got some idea, but hopefully through good management by this group of people that you don't know, things will work out well at the end. But in terms of property, you could actually have greater control. And the thing that really fundamentally attracted me to property was that you could touch it and also you could renovate it. So you can add value to it. In shares, of course, there's no ability to add value. You're a passive owner of shares. And you're there taking the back seat, hoping that the blokes, and it's typically blokes as we know, in front are actually going to make the right decisions and you're going to do well as a beneficiary out of that.
I think that's very interesting. I think that's a really very good observation and completely unlike you. But the one thing that we do share is my first investments were in shares, a lot older. But rather than doing analytics and having a spreadsheet, I just went out and listened to what a friend of mine who worked for Nikkei Securities suggested might be a good investment, ran down to the stockbroker. This was in the 1990s when I was in Hong Kong, and sat with the stockbroker on his very old-fashioned computer and bought the shares there and then. Right. With no due diligence, no concern. But, I was following, someone else's advice. And I kind of made a little bit of money, but I probably lost a lot more than I made with my dabble in shares. And I moved into property really not long after that because I realised that for my particular discipline, and even if you are very disciplined, as you quite rightly say, there are so many factors beyond your control when buying shares. Even when you've got all the right information at your fingertips, things can change very quickly environmentally, economically, but also in terms of the company and the way that it's run, things can happen that can change the direction of that investment very quickly.
Oh, that's right. And in fact, you're very much at risk of that. When I did my law degree, I also did a course to become a share broker because I was a bit torn as to whether I wanted to be a lawyer or be a share broker. And so I did a lot of studies and fundamental analysis and also technical analysis to get better experience. But at the end of the day, there's a risk involved, and that comes back to what we were just talking about.
Yeah. I think the funny thing is, Philip, that it doesn't matter when you're looking to invest, there are naysayers always about both property and shares. And my son is one of the biggest naysayers at the moment about property, saying, he's 21 years old. He's actually been a really diligent saver. He's also bought shares, sort of in his late teens. He's actually a very switched on young man, but he is very much of the mindset that now is not the time to invest in property. And you'll equally get people who have the same sort of sentiment and attitude towards shares. I think the fundamental thing is, depending on how you go about your investment strategy, then it's always the right time to invest in property. And it's also always the right time to invest in shares, as long as you know what you're seeking to get out of your investment. And as long as you understand, what your particular approach is. That's right.
I think that's very much the issue about where do you actually want to go? Where do you want to be? And what risks do you want to take along the journey?
I think one of the things that's always appealed to me about property is the phenomenal ability to leverage on your investment. And you can, of course, gear up on shares, but the risks are hugely amplified, sort of gearing up on other types of investments. But with property, the one thing I like for simple folk like me is I have, by default, a team of people who help support my investment decision. So as long as I've shown the ability to save up a deposit, be that 5, 10, 15, 20%, whatever it may be, depending on lending policy at the time or my appetite for risk, I have some of my own money. I then go and choose the property. Now I will get a whole heap of advice and support just by default. There will be a valuation of the property because if I'm borrowing money, the bank will demand that the property is valued. So that is an additional valuation of whether they want to lend money on that or not.
That's right.
I will also typically, I may have a mortgage broker who in this day and age will have access to, core logic data or one type of sort of, desktop valuation or another. I'll probably be working with my accountant because my accountant will be advising me around sort of my tax situation, and I will typically look to my accountant to help advise me about if I'm making a good decision. And accountants often have some sort of insight into, whether you're making a good investment or not. So I think, with property, when you are gearing up to buy property, you have so much support and advice, at your fingertips.
Well, look, I'm a believer in a couple of things just on those comments there. One is what I call a Zulu principle, and that is that you really become an expert. And I really believe that people should be able to make their own decisions as to what sort of property or where they want to buy. And for a lot of people, I advocate that for a lot of young people who want to undertake their investment journey, what I suggest is that they really learn what's happening in their own backyard for starters. The key to property, in my belief, is really location.
Yes.
Particularly residential property. So if you can identify an area which hopefully is a property you know well, and you've really got to try and become an expert on that property. So, for example, find a suburb which is undergoing gentrification. In areas of Brisbane, for example, at the moment, we've got Queen's Wharf project, we've got Cross River Rail, we've got also Brisbane Metro. That's really going to influence a lot of those near city suburbs, particularly on the south side. Now, some of those suburbs have done very, very well already, and they're quite expensive, but there are also poor cousins which are probably sitting just outside that area, areas like Maruka, for example, in Brisbane, where they are cheaper than more expensive areas closer to the city, but they'll benefit in the long term from the gentrification that's occurring in that area as well.
Let's talk about location in just a couple of moments.
We get it. You're here listening to the Smart Property Investment Show, and you're being interrupted by this ad. We value your ears just as much as your eyeballs, so we'll be quick. Join passionate property investors on Facebook today, and we'll fill your Facebook feed with useful tips and tools, plus free education from industry experts and a tribe of people who get it. Passionate property investors. Find us on Facebook now.
So, Philip, we were just talking a second ago about location, and it is one of the focal points of property, location, location, location. However, there is no one set location that investors should be looking at investing in. And let's say, looking at the share market, it may be there's a tech boom. So if you're generally looking at making money, you'll be looking at technology stocks. The great thing about property is you may have certain geographic locations in certain cities that tend to be growing for certain economic factors. But the bottom line is wherever you are, there is going to be a location somewhere near you that if you do the right research, due diligence, and look at the fundamentals, there are many locations that you can find a good solid prospect for an investment property.
That's right. And you can almost combine two approaches on that. One is a top-down approach. You could almost look at a map of Australia and just say, well, where do I think, using my futuristic hat, there's going to be some action? I'm a big believer that you make your money when you buy So from there, you look at areas which might have been struggling in the past. I mean, I look at Brisbane at the moment and think that actually represents good opportunity because it wasn't a beneficiary in the recent boom. And that's mainly due to lack of jobs growth in Queensland. But if you look at the Queensland situation now, you've got the infrastructure spend I just mentioned. Of course, you've got interstate migration, which has improved a lot as well. The key is that people actually have to get educated, and they've got to actually have an understanding or an interest in economics. I've got to say was an interest of mine as a young fellow, just to understand that. And the other part of it is to look at everything from a bottoms-up approach, so that once you've selected an area which interests you, from there you've really got to drill down and look at what suburbs or what properties in that suburb represent value. And Google's a wonderful thing, isn't it?
It is indeed, yeah.
You think how spoilt people are these days in terms of identifying properties. You don't even have to go visit the property. I mean, when I started out on property, my property journey, you'd actually have to hop in the car with the real estate agent and be driven around. You actually didn't know what properties were really available, only what you were told.
Yeah.
And I remember buying a unit years ago in Kangaroo Point, and the agent involved there was a dear old lady, but she was quite shrewd. And she said, well, in the entire Kangaroo Point area, there was only 2 properties available. I thought, oh, look, I couldn't believe that was true. But of course, she controlled that whole suburb. So at the end of the day, she showed me 1 of 2 units and said, well, there you go. That's the extent of the stock. Obviously, times are much different now. And as a result, people have got so much more choice and they become much more efficient at trying to work out whether, in fact, a property represents opportunity or not.
My feeling about property is time is a big factor. So if I'm looking to try and make money in 6 weeks' time, that greatly impacts what it is I'm buying. It reduces to an absolute bare minimum assets that might make me money. If I'm looking to make money over 25 years, it's a lot more forgiving. So the way that I view property, and I'm a long-term investor, I believe very strongly in long-term investment. So taking that as a given, I think as long as you make a reasonable investment choice over a 25-year period, you're going to do very well. However, if you do the absolute maximum due diligence, if you really drill down, if you really look at the places that are tipped for growth, not just now, but also for the long term, if you look at the fundamentals that are driving demand, that are also going to make sure that there are plenty of people there to rent, you can have a really profound effect on your portfolio over that same 25-year period. I think that it's quite a forgiving asset class.
Yes.
As long as you've got the basic discipline to kind of not look to try and make... I think greed is a really dangerous factor in any type of investment and none more so than property. But I think long-term investment can be very forgiving. But if you put the work, do the work, and you make money quite rightly so, when you buy, I think you can have some really big impact, really big impact on the value of your assets.
Yes, that's right. Sometimes the worst thing you can do to a property is actually do something. And other times, if you look at a typical house, well, you can add value quite easily. It simply could be a remodelling of a bathroom or a coat of paint. So property offers a lot of opportunities that way. I look at my wife and I, we bought a property 20 years ago in Camp Hill, and it's on 1,200 square metres. Well, Camp Hill now, through gentrification, has become quite a desirable suburb where it wasn't so much back in those days. We bought that property for $130,000.
Wow.
And it's worth a lot more now. And really, we haven't done anything to it. It's that's where property has been very, very kind over that period of time.
What was the motivation to pick that particular property 20 years ago? What made you choose? Was it bought as an investment or was it...
It was bought as an investment, yes, absolutely. It was becoming friends with a real estate agent at the time who had a knack for spotting opportunities and passing them on to me as saying that this is a good do upper sort of property on a large block of land, which will grow through the growth in the suburbs. So
that was, you bought that in the late 90s. How old was the property on that 1,200 square metre block?
I was built in the 1950s. So if you look at it from a cash flow perspective, I mean, there was no depreciation allowance. It couldn't rent terribly well. So for those investors who are looking at yield in terms of their investment, it didn't offer a great opportunity at the time.
Okay.
But I wasn't looking for that. We were really looking for something which showed capital growth.
Okay.
And the key, I think, also, which I'd like to stress to listeners, is that it's interesting the way people deal with agents. A lot of people look upon agents with quite a degree of disdain and think, oh, well, look, they're out there to rip me off and everything else. I actually make it a point to make the agent my friend. So when you go and see a property for the first time, I also make a point of asking the agent, the very first question I ask them is, why are the vendors selling?
Yes.
A lot of people, really get zone in on the property and all that sort of stuff. And they always create an emotional attachment to it. Whereas I look at things quite clinically, and that is that, well, first of all, the first thing I want to be satisfied is that the vendors actually want to sell.
Yeah.
A lot of people list property just simply to test the market.
They do.
If they get a ridiculous offer, a crazy offer, they'll decide to sell it. But I want to see that the vendor's actually committed. And if they say, oh, well, look, they're just testing the market, well, I just walk out because there's just no point wasting anyone's time. So you really have to be fairly hard about that. And of course, if the agent says, well, the vendor's going through a time where, they have to sell, or they bought another property, or they're going through a divorce or whatever, then that there's a capacity to negotiate.
I think that's a very, very, very astute observation. And I think that most, in a lot of times, buyers, particularly inexperienced buyers, view the agent as being the enemy. They treat them with suspicion. They obviously recognise that the agent is acting on behalf of the vendor. The reality is that the agent needs two parties to make a transaction. They want to sell the property.
That's
because
right.
they need to sell the property, first of all, for the vendor, but they also need to sell the property so they can make their commission. I think that if you go along, and I've been to multitudes of open houses, I've been, whether I'm buying investment property, whether when I've been through the process of purchasing my own property, I've made a specific point of getting on very well with the agents. And quite often when you're buying in a local area, you'll see the same agents again and again and again, and you kind of get to know them.
And of course, that's where there's a conflict between who the agent's really working for. Is it the vendor or is it the purchaser? But
it reaches a point, I think to your point, where the agent, they want to sell.
Yeah.
They are motivated and they are incentivized to sell a property. And to a certain degree, it doesn't matter a great deal to the agent whether, let's say you're talking about $1 million property, if they sell it for $1,050,000 or $1,070,000 to the agent in terms of their commission, there's not a great deal of difference.
No.
What matters to them is that there is a deal to be done. And the other thing that agents are very good at doing is to the buyers is giving the impression that there are a lot of other buyers. And it's easy to be put off as a buyer thinking some people can be pressurized into maybe putting in a higher offer. But I think a lot of people get scared off. The reality is I know from selling my own property on a number of occasions, you're lucky if you've got two buyers at any one time, unless it's a phenomenally hot market. So if you become skilled at dealing with the agent, actually showing that you are a very serious buyer, keeping the emotion out of it, treating them with respect, they're going to see you as being somebody who is a good prospect, and you're probably going to be in a position where you get at least more information. You can find out, as you say, the reasons why the vendors are actually looking to put the place on the market.
Yeah, and the other thing is through the agent, you can find out more information about the vendor. For example, it may be in the vendor's interest that they don't need to settle straight away. So it may well be, for example, that you can negotiate with the vendor if they're prepared to wait, provide you with finance yourself. I know when I've had this discussion with young people at our work, they're saying, well, look, I don't have enough money. I don't have enough deposit in order to get a loan to buy a property. But in a lot of cases, you'll find that the vendor is in a situation where they don't need that money, those proceeds straight away. They may be prepared to lend that back to you as on a second mortgage and earn some interest that way. So for those people who say, oh, well, look, I'll never be able to afford to buy a house, well, you just got to think a little bit differently.
I'd like to actually talk about sort of long-term planning just in a couple of moments. So, Philip, we were just chatting a second ago about some of the tactics of dealing with agents, but also as buyers and first-time investors, getting yourself ready to sort of get into the marketplace. You've been investing for a long, long time. The first property that you bought was sort of 20 years ago in your investment portfolio. I know that it's now a family-run business in terms of yourself and your wife manage that portfolio. Just looking back now to when you first started investing, how important do you think it is to have really clear goals, sort of financial goals about where you're going, and how much should that shape your approach to how you invest in property?
Well, I think one of the things I did when I was very young was I read a lot of goal-setting books and also motivation books, amongst all the other general books I guess all of us were reading at the time. But it really came down to self-improvement. And really that taught me about goal-setting. And really, I got to say, from quite a young age, I actually had a list of goals to achieve that year, but also long-term goals. I still do that today. I also think that it's important to maximise your income in order to be able to afford property. And I look at the opportunities which are available to people these days in terms of increasing their income. It's just so enormous. You can run your own business by being an import-exporter on eBay. You can drive cars at night on Uber. You can be a juicer for Lime scooters. There's so many things you can do. And I've got to say that I've always had multiple sources of income even from a young age. I was selling trees and things to businesses as a little nursery. I was making jewellery at one stage to help my father. From there, when I was a partner in a law firm, we ran a business called Career Development Centre, which actually provided training for legal secretaries and also teachers, because the government at the time had just brought in legal education, but no one had bothered to teach the teachers at that stage. So we did that. And to this day, my family and I are still involved in running our own property. So we're still out there trying to get extra diversification of income.
I think that's a really important point. And what you're prepared to give up or invest yourself in terms of your time is very much dictated by your vision moving forward. So, for example, a lot of people find it hard to save these days, but I think the reason being is because they don't have the vision to see what the benefit is of actually putting money away. And the same corresponds with doing an extra job. No one wants to work more hours for the sake of working more hours. But if you've got a really clear view of the goal, the objective, the benefit further down the track, then all of a sudden the motivation to earn extra money, to work extra hours, to do things that, you maybe don't want to do. I go back to myself and my business partner, Phil Tarrant. We set this business up about 13 years ago. But in the run up to setting this business up, we were both employed, working in media elsewhere. And we actually set our own business up after hours, and we would finish our day's work. Phil was an editor, I worked in sales, and then we would sit until about 10 o'clock at night doing corporate communications for a little sideline where we earned just, a sort of like a per hour salary for writing corporate communications. Now, that money, because we had a goal to one day go into setting up our own business and running it as a full-time thing rather than sort of like a bit of a side hustle, we worked away, we sweated, we grafted away. I had some investment property at the time. I've invested for a long, long time. We hadn't set up our joint portfolio by this stage. But we worked, we would often work till 12 o'clock at night. But the motivation for doing those extra hours, it was fairly small money that we earned for the labours that we put in. But all the money that we earned in our little joint venture, our little partnership, all went into a fund, which one day was enough to pay Phil a very, 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 very slim salary. I think about $40,000 a year. It worked out as a sort of a pro rata. But it was enough to pay him a monthly base of that amount of money for him to go up and set up Momentum Media, which we've got 120 people in the business now. We've got, sort of 20 different titles, including smart properties.
Yeah,
so
wow.
We had the vision of what we wanted to do with that little bit of extra money. And I think this is really important for investors, is understanding what you're prepared to sacrifice versus what you're looking to attain and achieve through your investment.
Yes, and it all comes back down through delayed gratification too.
Yeah.
It's very easy to be seduced these days. You've got to have the latest and greatest of everything. But I tell you what, you buy a new car now, in 10 years' time, it's an old car.
Yeah.
You sort of think, and it's still just a car. It doesn't do that much more than what old cars did. So there's a point that, maybe that's not necessarily what you should be trying to attain for at the moment. And also when it comes to lifestyle, and I know people say, back in the day, but back in the day, going out was just going to Pizza Hut. It wasn't having, a 5-course dinner and that sort of thing. So, and people but I've got to say in life, I look at things as being, there's no right or wrong in terms of how people want to choose to live their life. In terms of, economic prosperity, some people take the view, I want it now, but if you have it now, unless you put in place those plans to improve your wealth over a period of time, you'll wake up when you're in your 50s and you'll be no better off than what you were in your 20s.
But this is the thing, the people that I speak to, and I often keep quiet, but they will say, I can't afford to buy property. Yeah. And, look, I don't want to look into their spending habits or look at maybe their mindset in terms of how they organise their finances. But I think we're, generally so privileged these days. As you say, we all have the capacity to, most people have the chance to work additional hours in their workplace. Everyone has the capacity to go and get a little side hustle going somewhere.
Yep.
And everyone has the opportunity to really cut. It doesn't matter, sort of how you spend your money. There are so many things which we can all do without, where you'll see those extra dollars, mounting up. And I think that I think you make your mind up, you can either live for today and be happy with it. But I don't think you can I think it's very wrong to try and have your cake and eat it, to live for today, to be profligate in terms of your income, and then to complain that you can't actually get yourself into the property and the investment market.
That's right. And of course, the other thing is that, you look at your staff in Momentum and you look at our staff at Trilogy, there's ways and means for people to increase their income at our respective businesses as well. You're always looking for those people, particularly those young people who show initiative, to give them promotions. That we have a bonus structure at Trilogy, which is a balanced scorecard bonus system which looks at a whole range of issues, but there's a way there that people can improve their income at our respective businesses.
Philip, it has been absolutely fantastic catching up with you again. I could talk with you all afternoon, but I know that you're going to be catching up on one of our sort of sister podcasts, Nest Egg. If you haven't listened to Nest Egg before, do check it out. Look, it doesn't just look at property, it looks at investments across the board. So if you want to get a bit more insight into Philip and a little bit more insight into what he does with Trilogy, check out that podcast. You can find it on nestegg.com.au. For everyone, thanks so much for tuning in. Don't forget to give us ratings. Give us your feedback. We really want to know what you think about the podcast. Make sure you share, make sure you let people know. Check out all the latest news on smartpropertyinvestment.com.au. I'm your host, Alex Whitlock. Thanks for joining us.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
If you're a regular listener to the Smart Property Investment Show, then odds are you're already a property fanatic who loves hearing stories on investing from real people, the good, the bad and the ugly. Be with people just like you and join the group Passionate Property Investors on Facebook now. Become part of a community who know what to do and when to do it. And the time to do it is now. Passionate Property Investors. Tribe, tools and tips. Find us on Facebook today.